Owning a home. It's the quintessential Australian dream. For generations, Aussies have aspired to own their own slice of paradise, complete with a backyard Barbie and a hills hoist. This dream is deeply ingrained in our culture, fueled by historical factors like post-war prosperity and government policies promoting homeownership. But times are changing. The once attainable dream of homeownership is becoming increasingly difficult for many Australians to achieve. Skyrocketing property prices, coupled with stagnant wage growth and the rising cost of living, have created a new reality for many, being asset-rich but cash-poor. The phrase property-rich, money-poor describes a situation where a significant portion of an individual's wealth is tied up in property, leaving them with limited cash flow for everyday expenses or unexpected financial emergencies. Imagine owning a $1 million home but struggling to pay the bills each month. That's the reality for many Australians caught in this predicament. This situation often arises when people overextend themselves financially to enter the property market, leaving them with hefty mortgage repayments that eat into their disposable income. While their property might appreciate in value over time, they may lack liquid assets or savings to cover unexpected expenses, leading to financial stress and vulnerability. One of the primary drivers of the property-rich, money-poor phenomenon is the stark disconnect between house prices and wage growth. This issue has been brewing for years, creating a complex economic landscape that affects millions of Australians. Over the past few decades, Australian property prices, particularly in major cities, have experienced a meteoric rise, fueled by factors like low interest rates, population growth, and limited housing supply. The allure of property investment has driven demand sky high, with many seeing real estate as a safe and lucrative investment. This has led to a competitive market where prices continue to soar, making it increasingly difficult for average Australians to keep up. However, wage growth hasn't kept pace with this property boom, resulting in a widening affordability gap. While the cost of living continues to rise, salaries have remained relatively stagnant, putting a strain on household budgets. This stagnation in wages means that even as property values increase, the average Australian's purchasing power diminishes, creating a financial squeeze that is felt across the nation. This means that while many Australians might own valuable properties, their earning capacity hasn't increased proportionally, making it challenging to manage mortgage repayments, living expenses, and savings simultaneously. The financial stress is palpable, with families having to make tough decisions about their spending and saving habits. The dream of homeownership, once a cornerstone of Australian life, now comes with significant financial burdens. This disparity between house prices and wages has significant consequences. It not only affects individual households, but also has broader economic implications. The housing market's volatility can lead to economic instability, with potential ripple effects on other sectors. Moreover, the growing divide between property owners and those struggling to enter the market can exacerbate social inequalities. It makes it increasingly difficult for first-time buyers to enter the market, forcing them to either rent for longer periods or take on larger mortgages, increasing their debt burden. The barriers to entry are high, and many young Australians find themselves priced out of the market, leading to a generation of renters. This shift has long-term implications for wealth accumulation and financial security. It also puts pressure on existing homeowners, who might feel asset-rich but financially stretched, limiting their ability to save, invest, or enjoy a comfortable lifestyle. The financial strain can lead to increased stress and anxiety, affecting overall well-being. As the cost of living continues to rise, the challenge of balancing mortgage repayments with everyday expenses becomes more daunting. This financial tightrope walk leaves many Australians feeling vulnerable and uncertain about their future. Australia has one of the highest levels of household debt in the world, with mortgages accounting for a significant portion of this debt. This situation has been exacerbated by the country's booming property market, which has seen house prices skyrocket over the past few decades. As a result, many Australians have found themselves taking on increasingly larger mortgages just to secure a place to live. While responsible borrowing can be a pathway to wealth creation, high levels of household debt can trap individuals and families in a cycle of repayments, making it difficult to break free. The dream of homeownership can quickly turn into a financial nightmare when debt levels become unmanageable. This is particularly true for those who have overextended themselves, borrowing more than they can realistically afford to repay, leaving them vulnerable to financial shocks like interest rate rises or unexpected expenses. When interest rates rise, monthly mortgage payments can increase significantly, putting additional strain on already tight household budgets. Unexpected expenses such as medical bills or car repairs can further exacerbate the situation, leaving families struggling to make ends meet. The pressure to enter the property market, coupled with rising house prices, has led many Australians to take on larger mortgages than they can comfortably afford. This pressure is often driven by the fear of missing out, as well as societal expectations that owning a home is a key milestone of financial success. However, the reality is that many people are stretching their finances to the breaking point in order to achieve this goal. This can create significant financial stress, limiting their ability to save, invest, or even cover basic living expenses. When a large portion of income is dedicated to mortgage repayments, there is little left over for other financial priorities. This can lead to a vicious cycle of debt, where individuals are forced to rely on credit cards or personal loans to cover everyday expenses, further compounding their financial woes. High household debt has broader economic implications as well. It can affect the overall stability of the economy, as heavily indebted households are more likely to cut back on spending during economic downturns. This reduction in consumer spending can slow economic growth and lead to higher unemployment rates. It can dampen consumer spending, as heavily indebted households have less disposable income. When people are focused on repaying debt, they are less likely to spend money on non-essential items, such as dining out, entertainment, or travel. This can have a ripple effect on businesses that rely on consumer spending, leading to lower revenues and potential job losses. It can also increase the vulnerability of the financial system to shocks, as a large number of defaults on mortgages could have cascading effects. If a significant number of households are unable to meet their mortgage obligations, it can lead to a rise in foreclosures and a decline in property values. This, in turn, can impact the balance sheets of banks and other financial institutions, potentially leading to a broader financial crisis. Adding to the financial pressure faced by many Australians is the relentless rise in the cost of living. This phenomenon is not just a fleeting issue, but a persistent challenge that affects the daily lives of countless families across the nation. From groceries and utilities to healthcare and education, the price of essential goods and services continues to climb. Every trip to the supermarket, every utility bill that arrives in the mail, and every medical appointment or school expense seems to add another layer of financial strain. The rising prices on supermarket shelves are a constant reminder of the financial pressures. Utility bills, once manageable, now seem to consume a larger portion of the household budget. Healthcare costs, whether for routine checkups or unexpected medical emergencies, add to the growing list of expenses. These escalating costs put a strain on household budgets already stretched thin by mortgage repayments. Many families find themselves in a precarious position, trying to balance the need to pay for their homes with the necessity of covering everyday expenses. This cost of living squeeze further exacerbates the challenges faced by property-rich, money-poor Australians. While their property might be appreciating in value, their liquid assets are often insufficient to cover their daily needs. While their property might be appreciating in value, this increase in property value does not translate into immediate financial relief. Instead, it often means higher property taxes and maintenance costs, adding to the financial burden. Their ability to meet their day-to-day expenses is eroded by the rising cost of living, leaving them with limited financial breathing room. The stress of managing these expenses can take a toll on their mental and emotional well-being. Leaving them with limited financial breathing room, families are often forced to make tough decisions. They might have to prioritize which bills to pay and which expenses to cut, leading to a constant state of financial juggling. This situation can lead to difficult choices. Families might have to cut back on non-essential items, delay important purchases, or even forgo certain necessities to make ends meet. Families might be forced to cut back on essential items, dip into savings, or take on additional debt to make ends meet. This can create a cycle of financial instability that is hard to break. Or take on additional debt to make ends meet. The reliance on credit cards and loans can lead to mounting debt, which only adds to the financial stress and makes it even harder to achieve financial stability. This cycle can trap them in a precarious financial position, making it challenging to get ahead and plan for the future. The constant worry about money can overshadow their ability to enjoy life and focus on long-term goals, making it challenging to get ahead and plan for the future. The uncertainty about their financial situation can lead to stress and anxiety, affecting their overall quality of life. Families may find it difficult to save for future needs, such as their children's education or their own retirement, further perpetuating the cycle of financial strain.